Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. 2025 has been a great year for bond markets, especially emerging market bonds, which benefited from a weakening dollar. Additionally, normalization of monetary policies and the steepening of the yield curve took place. Well, I have on a very special guest who is going to help us look back at 2025 and look ahead to 2026. But first, this episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to give a very warm welcome to Dave Albrycht. Dave is the President and Chief Investment Officer at Newfleet Asset Management. Dave, thank you so much for coming on the show again. So glad I didn't scare you away after the first conversation. We had a great conversation about a year and a half ago, so it's great to have you back on to talk about us, the bond market, which continues to be fun and exciting. So can you please tell us a little bit more about yourself and Newfleet Asset Management?
Yeah, we've been managing multi-sector investments and dedicated strategies now for over 3 decades. We're in Hartford, Connecticut. We also have an office in New York City, where I'm at today, which is on 6th Avenue. And then we have an office in London, also with 2 guys who manage our institutional money, both in Europe and Japan. I would say that our strategy is based on finding relative value in the fixed income markets. When I started it, 30 years ago, it was 4 sectors, about a fifth the size of the equity markets. It had, treasuries and a little mortgage component, a little corporate component. It's now grown to 14 significant sectors. It's now 5 times the size of the equity market, so a little flip, and things that are very, very interesting. So he always says to me, you're always happy about something. I'm like, if I had 14 things that I'm happy about, one looks good, I'm going to definitely be happy about it. But another great year in fixed income. I've been saying for the last 24 months, relative value has been restored, and you've got very attractive yields where insurance companies, pension funds, institutional accounts get excited about fixed income again when you're getting investment grade assets at 4.5% to 6%, when you're getting securitized assets at 5 to 7%. High yield, now we're in the mid 6s, bank loans in the 8s, emerging markets, anywhere from 5.20 on the high quality stuff to the a little more speculative things that are yielding in excess of 9%. So there's very attractive yields, and bonds look like good value again.
Yeah, you're exactly correct. The savers are finally being rewarded after years of not being rewarded with, they're being rewarded with high yields and also total return. There's a lot of total return opportunities out there too. The AG in 2025 returned over 7%. High yield has produced, an 8% total return. Even the belly of the yield curve, the 7 to 10 year treasuries have returned nearly 8%. Great year. What's worked well and what didn't work well in fixed income in 2025?
I'd say in 2025, I'd first, take a look at the market and say more than ample liquidity. Market traded very strongly. As we mentioned, we just talked about yields being attractive. Also, and the point you made, a total return was available due to the fact that assets were offered at discount dollar prices. We well know if you pick an asset that's trading at 95 cents on the dollar and it matures at par, you not only get a nice coupon, but you get 5 points of appreciation, so you get a nice total return. Positive excess returns in all fixed income asset classes, which is very, very positive. And I think, as you mentioned up front, spreads were pretty much range bound, with one exception being emerging markets. And you had mentioned that emerging markets tighten anywhere from 50 to 60 basis points in that range, with high yield being the big outlier, tightening 135 basis points, generating substantial returns. High yield in the end was up over 16%. It's up over 16% year to date. I would say that if I looked at that market and said, what were the tailwinds? We had a very accommodative Fed. We were beginning to cut rates. We had a solid economy. Consumer was in good shape, and unemployment was very low at 4.4%. Earnings were good. Leverage was below long-term averages, whether you looked at investment-grade corporates or high yield. Positive flows, which resulted in very strong fixed income returns. If I had to look at some of the headwinds, for last year, or this past year. Tariffs, definitely the uncertainty there, which began on Liberation Day. Spreads, as I had mentioned, were, on the tighter side. We had some geopolitical uncertainty, which, we had to be very, very cautious about. Elevated inflation, we still have not hit the Fed's target of 2%. We've been over 2% now for a little over 4 years. And then some policy uncertainty. I think those are sort of the, would be my headwinds for last year. But the result, very, very good total returns, attractive positive excess returns, and people had a good year in fixed income.
Yeah, it's been a great year for fixed income. A lot of people talk about equities, the AI space, but fixed income though has been, like you said, high yield, despite a narrow or relatively narrow tightening of the credit spreads. Fantastic year there. So let's look ahead to 2026. Should investors expect more of the same in 2026, or should we kind of bring in our expectations a little bit? And where do you see some risks and opportunities moving forward?
Yeah. I would say that, that the current backdrop should persist into 2026. Fed will continue its easy monetary policy. We don't believe there'll be a recession, which is good. Moderate growth, so still positive growth. And this should lead to returns being like coupon plus returns. Now, maybe not as dramatic as this year, but still attractive when you have, like I had mentioned, I was just looking at some of the yields. IG corporates yielding 486, asset-backed securities yielding mid fours, the mortgage market yielding 470 to mid fives, high yield 670, bank loans 8%, emerging markets, as we had mentioned, low fives all the way up through 9%. So, coupon plus type returns. Now, things that persist in the market, rate cuts, but they're probably going to come to an end. Right now, I think the market's saying, I was just looking at it, 99% chance of a rate cut on December 10th. The market's calling for 2 more next year. I think the meetings are January, and then we have a meeting in March. And I think that's going to be, I'm thinking if they do a December cut, it's going to be more of a hawkish bias due to the fact that real data. So it's going to be a big thing to come out. We had mentioned, yields are lower and closer to par. I think one thing that's going to benefit the fixed income is, you had mentioned the big run up in the equity market, especially with the AI, is people having to rebalance and, get their portfolios back in line. So that may be positive flows into fixed income. So I would say it's still attractive as an asset class. Some of the things that I would watch out for, we have upcoming midterm elections, which are 11 months away. Geopolitical risks persist. We still have the Middle East and, more concern there about contagion, but hasn't been on the forefront. We have Russia, Ukraine, which now is approaching 4 years. We have China's growth trajectory, which we have to watch very closely. The economy of the world and a big driver of global growth. Something that people haven't been talking about, but leverage in the tech space. If you think about what happened very recently, and this is a percentage of issuance, but tech was about 2% of overall issuance. Now it's about 10%. We had deals from Amazon, Meta, Oracle, Google, to mention a few. And that's on a percentage issuance basis. So we have to watch that carefully. The Fed, what's the composition going to look like? Powell's term ends next year. There's going to be a few more appointees. Obviously, we'll have to watch that. And the thing is, we had mentioned, last year and this year, tight spreads will continue. So you have to position properly, and it's going to be driven by, I think, issue selection, sector selection top down, and then issue selection bottom up.
Yeah, interesting. I'm glad you brought up the issuance of those big mega tech names, Meta, and so on. It's big, huge issuances, borrowing for AI, supposedly. What's your belief in? Is that a risk? We all talk AI. It's the boom. It's the age. It's the next biggest revolution coming out. But is there some risks there? Do you think maybe we just uncertainty?
I think you go too fast, too far in anything, it becomes a risk and becomes uncertain. The one good thing is the companies that we mentioned are all extremely well capitalized. AA, AAA. If you look at Microsoft's a AAA, if you look at the others, they're single A, AA. So they're high quality companies. So I think they have the benefit of being able to issue that type of debt and be able to support it pretty easily. So That's one of the positives, but anything that goes too far too fast always makes me very worrisome. So that's it. I mean, just keep an eye on it. It's moving very, very quickly, and it's something that we're watching very, very closely.
Yeah, that's a very good point. A lot of opportunities there, but sometimes I have some nightmares and flashbacks to the dot com. Am I saying it's a dot com? No, but are there some kind of questionable companies and deals out there?
Yeah,
Maybe.
the dot-com bubble, I mean, it was 286 billion in defaults, companies that hadn't generated any cash flow coming with multiple billion-dollar deals. I remember it well. WorldCom, Enron, Adelphia. I remember it well. Yeah, everything was going to the moon until it didn't. So,
Yeah,
yeah,
exactly.
as my former boss used to tell me, Albrycht, there's no free lunch in the bond market. Anything that seems too good to be true probably isn't. Well, take that with a grain of salt. So, when things seem too good, you got to really take a step back and make sure you're comfortable.
You're exactly right. Read the fine print. Read the fine print.
There
Really
you
look
go.
at those numbers, right? What am I getting myself into here? You know, you talked about the Fed, maybe a couple more rate cuts coming up in 2026. A lot of those rate cuts that we've had in 2025 have resulted in the yield curve finally uninverting
Yeah.
after an extended period of being inverted. The yield curve steepened in 2025. Do you think it's going to continue to normalize in 2026 and steepen, or do you think we're kind of at that range now where steepening is probably stopped?
Yeah, I would say that, I'm not a big on anticipating direction of rates and movements. A lot of people came into this year calling for the, 10-year treasury to be well above 5%. Went from 460 to 480. And then in a blink of an eye during Liberation Day, we were below 4%. Now we're back to where we are like a 414 on the 10-year. You're exactly right. The curve has normalized. 2s to 10s is sort of the barometer we look at. It's 57 basis points. So we've normalized the yield curve. The Fed is definitely going to cut on the front part. I think the one thing keeping long rates sort of in check is it 37 or 38 trillion dollars of debt that we have, and that's something that becomes worrisome. It's 123% debt to GDP. I call us the best house in a bad neighborhood. We have some of our counterparts in Europe that are higher in the 140s. We have the outlier being Japan at 262. Until we go into a recession or have a major slowdown, that's when it's really going to become an issue, and we really have to deal with what's going on. You can't keep spending. You can't keep printing money. Somebody asked me what happens, with all this debt. I said, well, we can default on it, which we're not going to do. We can pay it off, which we can't afford. We can grow at 8% nominally, which ain't in the cards anytime soon, or we can continue to kick the can down the road and print money. So, you got to keep your eye on it. You got to deal with it. Tariffs are addressing some of it to a certain extent, but something we're going to watch very, very closely. It does become worrisome.
Yeah. Do you think it's interesting? I don't feel as if the headlines capture it very often, or it's not talked about as much as it should be. Do you think I feel as if maybe people are just kind of putting a blind eye to it because they don't want to think about it? Should we worry more about it than what maybe is out there in the media?
I think it's definitely a concern. It's definitely a concern, but like I said, until we actually have an economic slowdown, that's when people will have to deal with it, and that's when the government are going to have to deal with it. Nobody wants to, say we're going to raise your taxes or we're going to put some type of penalty on you. We're going to slow down the economy and hope they get elected, right? So it's got to be a happy median, but we have to deal with it, and it keeps on getting bigger. It's not going away. It keeps on getting bigger. So definitely a concern.
Yeah. Good point. Very good point, Dave. All right, let's talk about moving forward and talk about some opportunities in different sectors.
Yeah.
You mentioned high yield bonds the performance has been very good in 2025. You had asset backed securities doing very well. What are some sectors you believe are, most attractive for this year?
Yeah. So if I
Or
run
I
through
should say for 2026.
Yeah, if I run through all the sectors, I would say that first, if you want quality and you want duration, you're going to go to investment grade corporates. Okay, right there, they returned about 7.4% this year, so a great year. Dollar price is still at 95, so still at a discount, and a yield giving you right a little above about 486 as we speak. So pretty attractive. Our bias there has been the triple B space. We like midstream energy, regional banks, capital goods, those with contracted cash flows. But spreads are at the tight end of the range. We're at 77 today. They got to 73. That was a 27-year tight. So, could they get tighter? Yeah. Could they, continue to gradually, chug along and collect that coupon? Absolutely. So we'll watch it very, very closely, but I would say that, if I had to look at our entire strategy, we're up in quality. We have plenty of liquidity in the portfolio, and we're definitely a dip buyer. So this year, I think the big opportunities were agency mortgage backs, which were one of the uniquely got very, very cheap. Typically, they trade at, about a 50 basis point, you're 50 basis point tighter than corporate bonds. Yields were on top of each other at about 486, which never happens. So mortgages got cheap. Spreads were about 160. We added a bunch, and they went all the way back to where historical norms are about 120. So we got a nice total return, and you've seen that in performance. I think that the dips have been much shorter lived. The end carry trade was about a 5-week opportunity in leverage finance. The parliamentary elections in Europe with the snap election in France was about a 5-week dislocation. Liberation Day was about an 8-week dislocation. So there's a lot of money out there still in money markets, still on the sidelines wanting to get in and make that bet. But a lot of the things were very, very short lived. If I look at, high yield, you're mentioning high yield. High yield, up around 8%. We do have a discount dollar price there also, about 98. The yields are right around, as we had mentioned, 670, so pretty attractive. High yield is now the highest credit quality ever, okay? You had $284 billion of downgrades during the pandemic. Occidental, Kraft Heinz, Ford, Twitter, to mention a few. So all these big names fell. So even though we're at spreads of 270 in that range, they could get a little tighter. They could get a little tighter due to the higher credit quality. We'll watch it closely. There we're more market-like. You've got a maturity wall that's been pushed out, so there's not really a lot of issuance that needs to be had. We've seen very good flows, about $19 billion year to date. Defaults are way below the historical average of high threes. We're at 1.82 as we speak today. So defaults are still low. So the market's doing well, and market-like exposures is how we want to be. I'd say one of the areas that we actually sold was leverage finance, and leverage finance with bank loans. Even though you've seen, good overall flows, 19 billion of overall flows, a lot of that hasn't gone to the retail mutual fund. One of the big risks with this market when it imploded back in the global financial crisis was about 40% was in retail. Now it's only about 7%. So institutional, which is buy and hold, control a lot of this market. So as the Fed cut rates, and you trade off the LIBOR market, and that started to go down, we thought it was a good sale. Now we're taking a hard look and say if we're coming to the end of the rate cycle, up in quality and bank loans at 8% look pretty attractive. So we're starting to take a hard look at the loan market. Our good friends in private credit had really provided a lot of liquidity, not only at high yield, but also in bank loans, providing that extra source of liquidity and alternative financing, where instead of defaulting, they were able to get financing. So defaults here are around 3.16, a little below the long-term historical average. It's up about 5.4%. And as I had mentioned, yield right around 8%, which is pretty attractive. Get some of the other sectors, and I can run through these, but we talked about emerging markets. What a great year they've had. 61 billion of inflows. There hasn't been inflows into this market since 2017. Okay, now unlike 2017, where a lot of this flow went to dedicated funds, most of this flow, 60 billion, has gone to multi-sector type funds. So they're not going to the dedicated strategies, but they're participating through guys like me that are allocating to foreign markets. With strong flows, we like high yield versus investment grade, which was the right play. High yield is up almost 17%, while investment grade is up right around 10. That's the right call. Overweight sovereigns and overweight Latin America, which was the right call also. And very attractive yields. As I had mentioned, you're getting an investment grade 530, and you're getting almost 9% in high yield. So, and then the fourth piece of the puzzle is local currency, and as you mentioned, the weak dollar. Give you a great opportunity to get involved with some local currencies, Mexico, Chile, Colombia, to mention a few. And carry is king there. And really, when we're cutting rates, gives them flexibility to have their currencies to reshape with the dollar. So you've seen some good total returns. It's a great sector, but spreads are tight now. So We're evaluating, do we sell high yield EM to go into bank loans when the Fed stops cutting rates? Probably. It's probably not a bad bet. Right now, we like it because you've had some, good total return. So if I looked at, more broadly, we look at issuers that have very strong fundamentals, prudent fiscal management, and independent central banks. So that's sort of our forte, and it's done extremely well. If I look at the mortgage, we talked about mortgages, very strong credit fundamentals, supply is down dramatically. I thought this was interesting. We were building a million houses a year back in '07. '09 and after, they're only building 250,000 houses per year. So the shortage in housing versus family creation is about 700,000 per year. We've seen that for the last 14 years. So that's why, even though rates are high, we still have that solid foundation on home prices, and home prices haven't dropped like a rock. Mm-hmm. Plus, we've gotten rid of the 125% loan to value type mortgages and all the stuff that was crazy back in the global financial crisis. Very low inventory, good structures, supply is down. And one of the things I think kept us out of recession, and I was mentioning this to our mortgage guys when we were talking about it, was if you looked at Europe, about 80% of their mortgages are floating rate. When rates went to 7%, people felt the pain of their mortgage payment tripling. In the U.S., about 65% is in coupons of 3.5% or lower. So rates go to 7%, you're in a 3.5% mortgage or lower, your life doesn't change, you ain't moving, because you probably can't get another home, but you're staying in your house when you have an equity buildup, right? And that probably helped avoid, a lot of people defaulting on mortgage payments or, feeling extreme pressure. So we do like the mortgage market. We think it makes sense. We like agencies and non-agencies both did well. Maybe two more that I think will give us the asset-backed market. Top of the capital stack, front of the curve, franchise lease receivable deals, Dunkin' Donuts, Domino's, Pizza, Carl Jr.'s, Jersey Mike's. They make a payment to the parent for using the name. They securitize and sell it to me. They get the money and they build more properties. Those have done extremely well. Consumer loans, as long as you're on top of the stack, you're getting right around a nice yield of about 5% with a 2-year asset that's AA. So we like it. And then last but not least, actually there's two more. And I want to throw it out there. Commercial real estate was something that I was always concerned with. We have a maturity wall of about 120 billion coming due. We had some landmark properties by us. One of the insurance buildings in downtown Hartford, one of the main tenant left. It was a $122 million mortgage. They left, and the building defaulted. It resold for $21 million. That's pretty dramatic. We had Manchester Mall, and the shops at Manchester, $110 million mortgage defaulted, and it just resold for $10 million. So it's dramatic. It's pretty dramatic. And again, it's case by case, something we watch very, very closely. For us, we were doing single asset, single borrower deals, rural office, data centers, industrial warehouses, trophy properties like stuff on 6th Avenue that was fully occupied, Bellagio, the Willis Tower in Chicago. So very selective, and they've returned about 7.3%. And we're very cognizant of, office and hotel. Are people going to go back to the office? Are they still working for a week? Are the hotels, do they want to stay in hotels in the big cities? It's sort of a question mark, but watching it closely, a lot less exposure than we had in the past. And last but not least, and I got to throw it out there, I have to mention it, is the muni market. We had 44 billion of inflows. We had very, very heavy supply early on, which caused a lot of dislocation and it caused a trade-off. And, IG's up about 4%, while high yield's only up about 2.4%. However, taxable equivalent yields haven't been this attractive going back to the global financial crisis. Right now in investment grade, you're getting 6%. And in high yield, you're getting 9.45. Unlike Meredith Whitney did say, defaults in the muni market were going to be $100 billion. She's up by a little. It was actually 78 million that occurred. So 100 billion versus 78 million. She forgot one thing, that I can always, if I'm in a central service revenue bond or a GO, I can always raise your taxes and I'm not going to default. And really, I think the last fault, one of the last big faults was Orange County, which was fraud. So we haven't really seen defaults. We have seen some like in the nursing homes, the healthcare, smaller non-rated deals. If you stay in high quality names, double B and above, you stay in the large liquid names, you're getting those taxable equivalent yields. For me as a crossover guy, the ratios just don't make any sense. But as an individual, I have munis in my portfolio, so it looks good. Taxable munis are another one. There's not a lot of issuance. They're sort of few and far between. It's sort of oxymoron. When you go to the corporate desk, they don't want to touch it because it's taxable immunity. When you go to the media desk, they don't want to touch it because it's taxable. So it sort of falls through the cracks. We did Orlando Healthcare AA, got 85 over for a AA 10-year, which in the corporate bond market, you're getting like 15 over. So you can pick up some nice spread if you can find them. You got to be very, very selective. So I think those are sort of, some of the opportunities that we've seen. I would just categorize it by saying with, our portfolio management style, we have a very defensive posture. We're up in quality and we're better dip buyers. So when opportunities come about, we'll be very aggressive and go out, whether it's getting exposure in the cash market, doing through the derivatives market, getting immediate exposure, and then building out in cash, we can do that also. And really it gives you a lot of levers to pull when you have 14 sectors. So there always can be something that looks attractive out there, even though it's tight.
Yeah, that's fantastic, Dave. That's probably why you're always happy, right? It's fantastic information there. That was great. Let's talk about credit spreads. You've mentioned it quite a bit through the conversation.
Yep.
They remain tight, especially, after Liberation Day when investment high yield spreads, they spiked. They've really come down now, remain relatively narrow historically. Do you think investors are getting compensated enough for taking on risk? You said it's something to watch. You might, it might be if they narrow, you might want to get out of some of these tightening spreads and go somewhere else.
Yeah,
Is it something that
I like, we're up in quality, we're defensively postured, but we still have plenty of exposure. So we're going to benefit if you clip, just doing coupon clipping. Corporate bonds on the tighter side, there's still a great attractive alternative. When I look at Europe, if I look at IG corporates in the US, we're yielding 486. If I look at Europe, they're yielding 322. Asia's yielding 370. So it's still the best game in town. So we're still seeing positive flows come from, overseas. As it widens, could we buy more? Absolutely. It's something we're looking at very, very closely. Does it make me, I'll put it like this. Being defensively postured, not dipping down, taking a lot of risk, and being able to buy, having liquidity in your portfolio is, I think, the best way to posture it.
That's fantastic.
Best way to
Dave,
posture.
fantastic.
Lastly, I'm sorry, Ryan. I didn't mean to interrupt.
No, go
I was
ahead.
going to say, you'd asked me about private credit, and I failed to bring it up. So I thought what I would do is just give you a more quick overview. I mean, that we're public investors, but we do the private credit markets, and I looked at it last week pretty closely. It's about 1.75 trillion right now. Invested is about 1.25 trillion, so 500 odd billion is waiting to be invested. A lot of money chased a lot of that asset class. It provided great liquidity. It's an alternative financing market. First, it was the weak single B that couldn't get financing in the public market. They would opt out and have to pay more to go into the private credit market, but they got deals done. A lot of companies avoided bankruptcy. And what we saw happen was, because we were in a bull market and there was really, we haven't been in a recession, a lot of the guys that went to the private markets got financing, got their financial house in order, and then came back and refinanced out into the public markets and saved quite a bit of money. So they didn't default. They got their financial house in order. It provided great liquidity. Now, when a lot of dollars are chasing, a few assets, and it's sort of untested because it's been a bull market. If you think of the bulk of that's come out in the last 5 years, so we haven't seen economic volatility. It makes me a little nervous when a lot of money is chasing everything and people say, oh, I'm getting 8 to 10, 12%. I'm not taking any risks. Then I get nervous. If you look at price disclosure, that's something I worry about. Some of the cracks that we're starting to see, maybe companies are paying in cash, they're paying in kind, so they're adding more debt, which is a concern. And then I looked at some of the concentration risk. This is a risk. In private credit, commercial services are about 20%, while software is 23%. That's about 43%. In public loans, they're less than 20. So that's a big concentration. So an overexposure to AI, which could cause a disruption, if, as we talked about, if AI has a hiccup or something. Heavily skewed to B3s and triple Cs, so are lower rated, dramatically more than that of the public markets. Now, I'm not saying this is good or bad. I'm just saying that it hasn't been tested. Give me 4 negative quarters of GDP, and we'll see how it does versus the public market. Now, we haven't had that. So And when you still have 500 billion waiting to be invested, the premium you were getting, the 4% premium being in private versus public is gone. Now it's down to inside of 100. So a lot of the allure is still there because it's done well. Just be cautious. In my personal account, I'm a better profit taker right now and locking in some huge gains that we've had in private credit as opposed to adding more right now. So, do I have a market weight? Yes. Am I trying to take some profits and lock it in? Absolutely. Would I buy it back if there's a disruption? Absolutely.
Dave, that's some fantastic advice. I completely agree with private credit. I've had a lot of conversation. We could have a whole episode on private credit right now.
Absolutely.
Yeah, do I think it's a industry-wide systematic, risk? Not necessarily. I do think there's a lot of deals out there that, we could see some more cockroaches arise.
Yeah.
But that's kind of like any industry. You could invest in some equities and stocks and they fail too. So I think it's one of be selective.
I'm sorry.
No, go ahead.
No, we had some recent cracks. I mean, we saw, two issues, and these weren't necessarily private credit. They were in the public markets, but they were fraud. We had Tricolor and First Brands. Remember those? Then we had, some bankruptcies, which also were in the private markets, which were Zip Car Wash and Real Home Partners. So there is some, some concerns. And again, I'm not claiming these. There's defaults in every industry, but you just got to watch it closely and make sure you're comfortable with the reasons. When there's a lack of disclosure, illiquidity, opaque, and lack of transparency, you got to be careful.
You're exactly correct. One last thing. We've talked a lot. You've provided some fantastic information for all the financial advisors out there listening. How should they position their portfolios in 2026? I often talk diversification is back. It's back from being dead, but it's boring. It's not an answer anybody wants to hear, but it's prudent. Where do you think portfolios heading into 2026 should look like?
Yeah, I mean, I think it's back to the 60-40, and then you still have some alts in there, and you have a little bit of private credit. I think it makes sense, but I think fixed income is back as an asset class, which makes sense. You've had a nice run in the equity markets. Probably not a bad time to take some profits, and diversification is key. I mean, nobody wants diversification when you have a huge run up in the equity market. When you have a mediocre year in the equity markets and you're getting high single digits in fixed income, diversification is great. I want to be prudent. At this point in my life, I want to have exposure to equities, but I also want to have that fixed income anchor in my portfolio. Like I mentioned, private credit makes sense. As a portion of your portfolio, and alts. When if you feel comfortable with the alt market, I think it should be part of your portfolio. So I'm well diversified. I have definitely equity and fixed income. Diversification. I don't want to be concentrated in any one specific sector. I like the multi-sector approach, which gives you opportunities to go into every sector. Outsource that complexity of picking which sector you want to be into the guys that have done it for 3 decades plus.
Yeah, exactly. It's definitely the bond market, like you said, it is so big, all the different sectors. It dwarfs equity markets. Me trying to go pick out a bond issuance now, that's a bad idea. So, Dave, real quickly, how's UConn looking this year? Are you going to make another run for the championship?
I certainly hope so. I think we've only lost one game to Arizona where our two big men were out. They out-rebounded us by 20, and we were actually up with a minute left in the game, lost by 4 at home. I think UConn looks really good. Tonight we have Florida at Madison Square Garden. So something I'm watching. I'll be there watching the game very, very closely. And I think Dan Hurley's a great coach, brings a lot to the table. His recruiting is outstanding. We've got definitely a deep team, and we're going to be very competitive. The UConn's definitely going to be in the top 5. And I think it gets, we've already played. We played and beat Kansas. We're playing Florida tonight, which is Tuesday. We play Texas at home on Friday. So we beat BYU up in Boston 2 weeks ago. So it's been competitive. It's been good. It's a fun season, and I'm fortunate enough to be able to get to most of the games. So I wish them the best, and I'll be there supporting them. But I think UConn has a good chance to make it quite a far way.
Good. Well, I am just going to leave it at this. I'm glad Hurley didn't go to the Lakers. He's fun for college basketball. And I'm on the fence about whether I like UConn or not, but it's good for college basketball when UConn is good.
We can't forget the UConn girls. The UConn girls are still they're doing well. And they could repeat. Gino at the hockey game Saturday night, and you know what? Gino is, I believe, 70 years old. He looks like he's in his 50s. Looks great, and still very, very much into it. So I think the UConn girls look like they're headed for the finals too. So
Take out South Carolina. Go UConn girls.
yeah, UConn girls. UConn girls.
Awesome, Dave. Thank you so much for coming on the show. Another fantastic conversation. Always enjoy. I know whenever we have a conversation, I'm going to learn a lot. So this time was no different. Where can our audience get more information about Newfleet Asset Management?
Go to Virtus.com. It's Virtus, VIRTUS.com, Virtus Asset Management, and we'll list all of our funds. We're the fixed income segment of Virtus Financial Advisors.
Fantastic. And I'll put that link in the show notes so our audience can locate it. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Please be sure to like and follow those YouTube channels and subscribe and follow us on LinkedIn. Thank you very much, and have a great rest of your week.
Thank you, Ryan.